Welcome back to class, and this is the second module of the course, Advanced Financial Accounting, and we'll be looking at financial statements presentation and corporate reporting framework. Financial statement presentation and corporate reporting framework, and this is actually very important aspect of the advanced financial accounting, and I want you to listen. It's going to be brief, and the note is available, and we will look at the objective of general purpose financial reporting, the components of a complete set of financial statements, the financial statement format under IFRS and US GAAP, and we will break it down into looking at the statement of profit and loss and other comprehensive income, the statement of financial position, statement of changes in equity, statement of cash flow, and notes to the financial statements. These are the things we will look at. We may not be able to look at the calculative aspect of it, but we will understand the basic knowledge of every of these that are listed. Financial statement presentation represents the culmination of the accounting circle, transforming detailed transaction record into meaningful information for diverse stakeholders. And in contemporary business environment, financial statements serve as the primary communication medium between organization and investors, creditors, regulators, employees, and the public. And this module explore the comprehensive framework to presenting financial information under both international financial reporting standard and the US generally accepted accounting principle, that's GAAP. Let's look at the objective of general purpose financial reporting. And according to the conceptual framework, the primary objective of general purpose financial reporting is to provide financial information useful to existing and potential investors, lenders, and other creditors in making decisions about providing resources to the entity. And this decision involves buying, selling, or holding equity and debt instruments, providing or settling loan, and exercising rights to influence management action. And users need information about economic resources and claim, changes in those resources and claims, cash flow, and management stewardship of resources. The component of a complete set of financial statements, it's actually found in IAS 1, and a complete set of the financial statement under IAS 1 include the statement of financial position, the statement of profit and loss and other comprehensive income, the statement of changes in equity, the statement of cash flow, and the notes to the financial statement. And entities must also present comparative information for the preceding period and an opening statement of the financial position when retrospective application or reclassification occurs. And the financial statement must be prepared on a going concern basis under the accrual basis of accounting and must fairly represent the entity's financial position, performance, and the cash flows. Looking at the statement of financial position, it's known before as a balance sheet, and this is actually the statement of it actually represents or presents an entity's assets, liability, and equity at a specific point in time. And assets and liabilities must be classified as either current or non-current based on when they are expected to be realized or settled within the entity's operating cycle or within 12 months. And when we say it's being realized, it's actually for assets, and settled is for liability. The current assets include cash, inventory, and trade receivables, while non-current assets include property, plant, and equipment, and intangible assets, and we have them as such. under the statement of profit and loss and other comprehensive income, this is actually one that it's a statement that presents both profit or loss and other comprehensive income, and it includes items not recognized in profit or loss, such as, for the other comprehensive income, it includes items not recognized in the profit or loss, such as the revaluation gain and foreign currency translation differences. And entities may present this information in a single continuous statement or in two separate statements, one for profit or loss and one for comprehensive income. And also, expenses in the statement of profit or loss may be classified either by function, such as costs of sales and administration expenses, or by the nature. Let's look at other comprehensive income components. And for this, we say items that will not be reclassified to profit or loss include revaluation surplus on property, plant and equipment, and this is actually when an asset is being revalued, maybe property, plant and equipment is being revalued, and there is a gain on it. It's under this. And remeasurement of defined benefit pension plan and changes in the fair value of equity investment at every OCI. And items that may be reclassified subsequently to profit or loss include the foreign currency translation differences, the effective portion of cash flow hedges, and changes in fair value of debt instruments at every OCI. And each component of the other comprehensive income must be presented net of tax, and the total comprehensive income for the period is the sum of profit or loss and the other comprehensive income. Looking at the statement of changes in equity, it actually reconciles the opening and closing balances of each component of equity, including the share capital, the reserves, and the retained earnings. And it shows total comprehensive income for the period, transactions with owners, such as the share issued and dividend, and the effect of changes in accounting policies or correction of errors. This statement, however, provides a clear link between the statement of comprehensive income and the equity section of the statement of financial position. Looking at the statement of cash flow, which is another component of a comprehensive financial statement, the set of financial statements, and this is actually that which provides information about cash receipts and payments during the period, and it's classified into operating, investing, and financing activity. And looking at the operating activity, it actually they are the principal revenue generating activity, and the investing activity involves the acquisition and disposal of long-term assets, while the financing as activity relates to changes in equity and borrowings. And entity may present operating cash flow using either the direct method, which is reporting gross cash receipts and payments, or the indirect method, which is adjusting profits or loss for non-cash item and changes in working capital. For the note to the financial statement, note provides essential information about the basis of preparation, significant accounting policy, and supporting details for items presented in the financial statement, and they must include a statement of compliance with IFRS, a summary of material accounting policy, and disclosure about critical judgment and estimation uncertainty. And notes also covers specific line items such as the property, plant, and equipment trade receivable, property, plant, and equipment, trade receivables, provision, contingent liability, and related party transactions. Looking at the critical judgment and estimation uncertainty, management must disclose critical judgment made in applying accounting policies that have the most significant effect on the amount recognized in the financial statements. And the key sources of estimation uncertainty include impairment assessment, provision for expected credit losses, defined benefit, pension obligation, and fair value measurements. And the disclosure helps users to be able to understand the assumption and estimates underlying the financial statements and the potential for material adjustments in future period. And looking at the differences in the presentation of IFRS and GAAP, IFRS offer more flexibility in financial statement format, while the US GAAP provides more prescriptive requirements, especially for the SEC registrants. And key differences include the classification of expenses, the presentation of other comprehensive income, and the treatment of certain items such as extraordinary items which are not recognized under IFRS, and we have it well explained in the notes. Entities operating in multiple jurisdictions must be aware of these differences to ensure compliance and to prepare any necessary reconciliation. Looking at the professional responsibility in financial reporting, financial statement presentation requires professional judgment, either ethical integrity and a thorough understanding of both accounting standard and the entity's transaction. High quality financial reporting enhances transparency, supports efficient capital allocation, and strengthens stakeholders' trust in the entity and capital markets. An accountant must balance technical compliance with the need to provide clear, relevant, and reliable information that meets the needs of users. In conclusion, financial statements presentation is a critical professional responsibility that combines technical knowledge, regulatory compliance, and strategic communication. And the principle covered in this module, from the objective of the financial reporting to the detailed requirement for each statement, provides the foundation for professional competence in financial reporting. And having a mastery of this principle equips accounting professionals to be able to prepare and present financial statements that are transparent, reliable, and useful for decision making in a complex global economy. Thank you.